I've been getting a lot of questions regarding different sectors. One particular comment about where I see the value in terms of my highest conviction plays, and so I'll go through those perhaps in another video. But today, one thing in which I'm really excited to talk about is this idea of shipping, okay, which is kind of related to the offshore drill rig sector in a strange way, and I'll explain how that is in the video. In the video, we're going to talk about the macro thesis all the way down to a couple of companies I think are trading at steep discounts to their net asset value, and how I'm approaching this particular investment thesis. If you haven't already liked and subscribed to the channel, I would greatly appreciate you doing so. And if you haven't already checked out the portfolio on eToro, download eToro, and then you can add us to a watch list and keep up to date with everything that's happening. eToro is a great brokerage if you just want to get access to a commission-free broker. So with that being said, let's get into it. So I've spoken a lot about different macroeconomic trends, and so I'm not going to rehash a lot of that. You can go through and look at some of my other work. It's all available on the channel, guys. Macro. So we're in a commodities bull market that I believe will last several years, perhaps even this entire decade. Reason being is that we've had a large amount of supply dearth, which has been thanks to a lack of capital investment before COVID, before the war in Ukraine and all this sort of thing. Okay, those things really escalated how dire the situation has now become. We've got a lot of cost push inflationary pressure, which we'll talk about. We've got demand pull inflation. So basically, cost push inflation is where you have a scarcity of supply. You therefore there's less available supply, and so prices for whatever the given good or service or commodity has to rise. Okay, you've got a stable demand and diminishing supply. People still want that particular commodity. There's a diminishing amount, and so the relief from which is always the price, as well as the fact that we've had M2 money inflation, so the amount of currency units in the system, with a lot of the fiscal and monetary policies that we've seen particularly since COVID has certainly amped things up. However, since 2008, we've had very easy monetary policies, which has contributed, shall we say, to some of the input cost inflation. And if you're a producer of these given commodities, then it's costing you to get more of your commodity out of the ground, or to grow more of your commodity, package it, transport it, etc. And so that all leads to pressure on the upside in terms of consumer prices. And we also are starting to see the beginning of severe demand pull inflation. So once people start to see prices rising, what happens then is people tend to think, well, gee, I better start buying more now, because if I wait a month or another quarter or another year to buy food, the refrigerator, all this sorts of thing, then you may be paying more for it, because you just keep seeing this spiraling prices going higher. And this was interesting. On the weekend, I had an example of, we're going to buy a bigger fridge to put some, different cured meats and butchered meats and things in our garage. And so my dad was saying, you better run in right now and buy. There's one left at, I believe he said Harvey Norman. It doesn't really matter. The point is, anecdotally, we're starting to see that in terms of demand pull to go with a cost push inflation. So you've got demand pull, you've got supply dearth, and all this monetary inflation in terms of the currency units. It's starting to be a perfect storm, and not in a good way, okay, in a bad way. Then we've obviously got Russia and Ukraine. That will continue. Who knows how long that will go on. Hopefully it ends as soon as possible, but sanctions can remain in place after the war, guys, and then in fact that affects commodities markets and the transport markets, of which we're going to speak about today. So where does shipping come in? Well, we talk about transportation in general. Commodities need to be transported. Europe, for example, energy importer, commodity importer in many ways. They're hugely reliant on that. There's just not the space to grow as much in the way of dry grains, for example. That's why war in Ukraine is such a big deal for places around the world, because places such as Egypt, Lebanon, Sudan, various other places, Western Somalia, I believe, they rely almost 100% on Ukraine for their wheat imports. Okay, this is crazy. So you have to have these commodities being moved from point A to point B, okay, from the seller to the buyer. And now we have these supply routes that have been disrupted, with the Russians taking over Mariupol. They'll be annexing Crimea shortly. they're basically taken over Odessa and the Black Sea. And so the point of all that is you can't simply cut through those straits with shipping commodities like you could. The whole landscape has changed, and you see the increase in terms of the miles that these transport operators have to do. So the way that this works is that if you're a ship operator, you're going to quote on the amount of tonnage, you're going to quote on the amount of days taken, the amount of times or the amount of time taken for you to move your commodity from point A to point B. And if that trip increases, kind of like you're in a taxi, if that taxi trip takes an hour instead of 10 minutes, well, then you're going to be paying a multiple of what you'd normally expect to pay. And that's what's happening with some of these supply routes that have been disrupted. Sanctions ongoing, that's going to contribute to that, as I've mentioned. Then we're looking at the micro. Okay, so we've gone from the macro, meso talking about the sector, and the micro. So how am I going to play this sector? What companies am I interested in when it comes to the Baltic Dry Index? Okay, those that carry dry bulk, basically, so grains, coal, iron ore, those sorts of things. And then you have your tankers and carriers, okay, which carry liquefied natural gas liquids, oil, crude oil, that sort of thing. Okay, they take it to refineries and they take it to the end consumer. So they're your two main ways to play this theme. I'm going to talk mainly about dry bulk carriers today. So how do you value a shipping company? Okay. Oftentimes, as you guys know, I like to be a cash flow investor. I like to use discounted cash flow. And if the present value of those discounted future cash flows look really cheap to me, then I'm interested. Okay. It's a little different with something so cyclical. These guys fluctuate with commodities. Or the broader economy in general, I would say. Their rates are going to be a factor of their utilization. So how many vessels they have being rented, if you want to think of it that way, and therefore what sort of pricing power do they have. So if there are a whole heap of ships on the ocean and there's just sort of so economic activity, no one's going to be that interested. There's just not going to be that much of a demand for these vessels, and so you're not going to be able to charge a premium if you're the vessel operator, right? Pretty simple. So what if we look at the net asset value? Much easier to work out net asset value and what you're paying in regards to that. The other reason that net asset values plays are interesting to look at is when you come into economic hardships. Something that Walter Schloss always looked at was it's much more difficult to predict earnings. It's much easier to look at asset values. And if you're buying these things at good discounts to their book value or their net asset value, over time, you should do very well. And if you're familiar with Walter Schloss, he's another alumni of Warren Buffett, who studied under Benjamin Graham. They took the same course at Columbia, and I think double-digit returns for something like 50 years in the market. It's incredible using this investment philosophy. So we're buying steel, basically. We're buying steel above the ground that is in the shape of a vessel, all right, that also produces some cash flows. I'm very bullish on steel for various different themes. One of those is electrification, which you'll know about if you've been watching the channel, the commodity boom that I've been talking almost endlessly about, and government reckless infrastructure spending. Okay, so we'll talk about that theme another day, some ways in which I'm looking to be positioned for increased spending towards roads and infrastructure transportation, that sort of thing. Steel above ground is obviously more accessible than steel in the ground, okay? So when steel starts to become expensive, and we saw this in 2020, day rates for these ships was terrible, and so steel prices were fairly high. And so what most of the operators decided to do was actually sell their older vessels for scrap, okay? Cash flows, they're often distributed as dividends. These companies are polite enough to dish out and have very high payout ratios. So depending on the balance sheet, that can often be a very, very good thing in that we know what we're investing in, we're getting that dividend back, and then we can decide how to redistribute that capital as of when we receive that cash. Something that I've been thinking about, something I've been hearing a few people say, not many, but I think someone like Cuppy, if you listen to a lot of what Cuppy says, given all the inflation that we're seeing, I think it's going to be a longer cycle, this cycle, than normal. Normally, these guys have a good couple of quarters, maybe a good year or two, and then that's it. They go back to being terrible capital-intensive businesses. I think it might be a little bit longer. I think we've had decades of supply chains becoming more integrated, And the trend now is to de-globalize. Since COVID, we realized how reliant we are mainly on China, but how reliant we are on having this just-in-time mechanism where we're sacrificing stability and security for certain suppliers, particularly energy is a hot topic at the moment, in exchange for a very efficient, cost-effective supply chain. So we have cheap labor in China, we have cheap energy in Russia. We outsource as much of those respective things as we can to those respective countries. That all works wonderful. We have wonderfully well. We have wonderful lifestyles. Cost of living is kept artificially cheap. But what happens when the security of those two things starts to come into question? So we're going to have a longer time of it. I think sorting out this supply chain will probably take over a decade if you read some of the work that Jim Rickards has done on this. I don't think it's going to be solved overnight, put it that way. Let's take a look at the supply side. You know me from the Jim Rogers school of supply first, then look at demand. Dry bulk fleet growth, okay, below 2% and expected to peter out over the next few years. We've gone through this cycle of oversupply, then we've had a large contraction because of low day rates and high steel prices. So as I said, a lot of the vessels have been scrapped. And so it's getting to be a very tight market, similar to the offshore rigs. This is where I see them as similar or analogous plays, in the sense that a lot of those guys went bankrupt, the competitors are out, they put a whole heap of drill rigs into cold storage. And so it's just going to take a very, very high day rate for these guys to want to, it's such an expensive capital intensive business. You've had all these rigs start to contract, or rig numbers, utilization rate has come up. Same deal here. We've had vessel numbers come down. Utilization rates have gone way through the roof. If you look at Castor Maritime, they had 99% utilization rates in their last quarterly report, which is crazy. Once you start to get 99% utilization, you up your prices, okay? Let's take a look at demand. So demand for dry bulk. Do you think we're going to need steel? Do you think we're going to need wheat, grain, and other dry bulk commodities? If you know the answer to that, if you've seen my previous videos and what I think, and I think that the demand rates here for these are different types of vessels. So if you look at the Capesize in particular, that sort of greeny arrow there, growing at 6% out over the next few years is what I would expect. And that's a huge growth rate on top of an already shrinking supply, which means, generally speaking, all else being equal, you have higher price, high day rates, which means more cash flows for these particular service providers. If you look at the day rates, here's the day rates over the last 2 years or so. Okay, so from end of 2019, day rates were really low due to the initial oversupply. COVID came, they stayed low. They went even lower for a little bit because demand for goods obviously slowed up quite a bit. Then we had a whole heap of scrapping. And then, as you've seen, since the turn of 2021, they've been on an absolute mission coming up towards the sort of $30,000 a day in terms of day rate. That's what these guys are charging out for most of their vessels. Oh, I'm sorry, I got ahead of myself. The chart on the right gives you a longer dated view. Okay, so you can see how high these particular rates can get. Okay, the BDI over the last year, Baltic Dry Index. Here the rates are closing at around 32.53. Okay, I think we could get back up to 5,600 fairly shortly, in short order. If we were to do a reversion, this is the BDI over several decades, how high could we get? I don't know if we'll get to the point where we're at 2008. I don't see any reason why not. I think fleet numbers are slightly lower. I think that we have a hell of a lot more global turmoil rather than just a financial crisis in the housing sector in the United States. I know there were further implications from that, but we have a kinetic and a cold war going on at the moment. So I think that takes a lot longer for that to realize. So Forex, could that happen? I don't see any reason why not. It'll be interesting to see what happens in terms of the index and which particular individual names are going to profit from that the most. here I have, this is not an exhaustive list, guys. This is just some that I've kept my eye on. We've got Starbulk, and we've got CTRM Maritime, Castor Maritime, Zim Shipping, and then we've got the two from the tankers. So we've got Torm and Scorpio, which I used to own, and I stupidly reduced my position after I just had a different opportunity cost, and the thing has doubled since I sold. So there you go. Don't always get the opportunity cost correct, put it that way. So here we have the price performance over the last, I believe, year to date. No, sorry, 1 year, calendar year. And you can see Zim has gone through the roof. They've done very, very well. And some of the others here are lagging behind. Castor Maritime down 50%, and a lot of that's due to them issuing shares, so diluting. The reason they did that, though, was to buy vessels at very, very cheap prices. So in the upswing, they will have more vessels to rent out, because remember, they're at 99% utilization rate. So they should look, the management can pull it off the way that I think they can. They should be looking at some handsome profits over the next few years. Okay, here we take a look at without the percentage, and we just look at the price action in its pure quote. Okay, so my consideration, what am I looking at? How am I approaching this particular investment thesis? So for me, balance sheet first for the core positions. I'm not against taking on a levered player. For instance, in the offshore sector, I do own quite a bit of Transocean. It's got a lot of debt to it, and I think that that's why the market has really priced it down. But if you look at it, if you were to trade it 1 times its book value or replacement value, there's a 4-bagger or a 5-bagger from where we bought it originally. Okay, so I believe that it is appropriate to have a small allocation to some of those plays, but obviously you don't want to roll the dice with your entire capital stack, right? So balance sheet, survival first. Is the company solvent? Can they ride out a wave of cyclicality? Okay, nice little typo there. So if we have global economic turmoil, which we're almost guaranteed to have the way things are traveling, very volatile, you'll have day rates go up and down and up and down and up and down. I think secularly they'll continue to go up, but we need to be able to ride that out in terms of companies in which we invest. Looking for basically cash with low levels of debt, negative net debt if possible. So it's got more cash or assets on its balance sheet than its liabilities. I'm looking to buy them at a discount to their net asset value and their tangible book value, and looking for what sort of free cash flow yield they can have. You guys know I really like to get that cash back as quickly as possible, and I'm less concerned with what the market thinks about the valuation. If we're getting cash in, day out, life is generally okay. Opportunity for multiple expansion, I think certainly. If you look back over time, twice the replacement value is, the market's been very willing to pay twice the replacement value for these types of companies in an upswing. Now, replacement value is not as easy to calculate if you want to do it really, really well. So you can use, or I like to use, net asset value and tangible book value as a proxy, but just bear in mind, technically there are some differences there, and it depends on the accounting. So if they've depreciated a lot of the fleet, or if they have older fleets, there can be some question marks as to what the current replacement value is today versus when they entered it into the books, and how accurate has the reporting been, and all that kind of thing. So let's take a look. Here are the positions in which I'm long, just the dry bulkers. Okay, doesn't mean I don't like other plays, guys. It's just, this is what I've got at the moment, and these are my thoughts essentially on the sector. So we have the biggest position in Castor Maritime. It's the more speculative play, but it does have a hell of a lot of upside, I believe. They have currently tangible book value of $3.84 roughly. Okay, and you're paying about 4 times next year's EBIT, trading at $1.88. I think the book value, you could easily see a 2 handle on the valuation for the book value. So we could easily see this at a $6 valuation based on the book value alone, and you'd be looking at a bit over 3 times return on investment for that. ZIM is slightly a different play, considering it's already trading at around about twice its book value. It's a very, very solid company. So this is more of a solid company in the sense they have a very strong balance sheet. You're only paying just over 1 times next year's EBIT. They pay a humongous dividend yield. And so your free cash flow yield is over 40% as we speak, based on expectations and current prices moving into next year. So it goes ex-dividend this week, so expect the price to actually drop, okay, because the dividend will be paid out. That always happens. I'm not worried about that. I may buy some more if I believe it appropriate. We'll see how we go. Currently got about 2% allocated to ZIM and roughly 3% to CASTAR. C-Time Marine, we've got $1.20 it's trading at, and we've got a book value of 1.4, trading at around about 5 times next year's EBIT. If we were to get to twice the book value, you're looking at around about $3. Their balance sheet is quite decent, and so you'd be looking at 2.5 times, a bit less than 1% allocated. Would like to allocate a bit more. The newbie, the specky, less than 1%, less than 0.5% at the moment. I'm trying to build out. Is a very illiquid stock. Okay, trades GLBS, Global Bulk Shippers, I believe, trades on the Philippine. It's a Filipino company, and so book valued around $7. EV to EBIT 1.35, and obviously if we could get it, I don't know if you'd get a 2x for this type of company. Given the liquidity, maybe not, but even if you could get a one times book value valuation, obviously you're making a lot of money on this one. So potential for a 7 to maybe even a multi-bagger on top of that. Interesting to see how we go. I'd like to bring these ones up to about 1%, and then I'd sit back and reevaluate. The risks. Okay, so rates are generally tied to demand over supply for vessels. So if you've got an economic slowdown and people aren't spending as much on given commodities, or they're not manufacturing things that require a lot of importation of met coal, for example, metallurgical coal going into steel fabrication, so on and so forth. Iron ore would be the same, bauxite, etc. Then you'll see you'll see a downturn in the demand. Then these guys will have to lower their rates, so therefore they have lower cash flows. So you are a little bit reliant on the economy in that sense. Recession would decrease demand, as I mentioned. The question is, we've got such a decreasing supply. Would it decrease demand drastically enough to offset that shrinking supply? And I don't know, given how things are really so tight. And that's why, if we're looking at companies with solid balance sheets, if there is a bit of a downturn, it's no big deal. They're still producing a decent amount of cash, and they can kind of ride out that particular wave. All right, given that we're talking about shipping. So the verdict, I'm looking to put in 5 to 7% AUM potentially to the entire sector. I will break that down because I'll look for some with higher gearing, high leverage, and some much more sort of slower, steady, stable dividend payers, steady as she goes. And so I'm questioning adding to my tanker exposure, but focusing on dry bulk for now. As I mentioned, I should have had a 2-bagger in Scorpio. I decided to put that into other opportunities. We'll see how that story ends. Tankers have kind of run away on me a little bit, so I'm not going to go chasing them. If I see a decent opportunity out there in terms of discount to NAV and solid balance sheet, I might take it, but we'll see. Thanks for watching. If you haven't already liked and subscribed, I would appreciate you doing that. And if you're looking for a value fund and you like the way that I invest, you might consider copying the portfolio on eToro. Otherwise, you can add us to a watch list and simply keep track of how things are going. I'm also on Twitter, should you wish to connect. Disclaimer, I'm not a financial advisor, okay? I don't know your circumstances, so please don't mistake anything that I say on this channel or anywhere as advice. It's not, it's just my opinion and what I am doing, okay? You feel free to make your own decisions. You guys have to be responsible for the decisions that you make. What is right for me might not be right for you, and so you need to understand that and take this disclaimer very seriously. Having said that, I hope that you enjoyed the video, and would love to see a comment in the comments section. And